Welcome to Investomania, brother.
Boom! Let's talk about Starbucks. Last June, after warning that fiscal third quarter sales and earnings would not meet expectations, Starbucks fell to levels not seen in years. The coffee giant's management team noted the disappointing numbers resulted from short-term problems. However, investors remained cautious of the stock. Shareholders' fears were not eased when the actual third quarter earnings report hit the street. Nonetheless, the executive's claims proved true, as throughout the next quarter, Starbucks' stock rebounded significantly, and the stock's impetus appears to be on track for even stronger growth in fiscal 2019. There is a lot left to be desired in Q3. Despite record-setting top and bottom line numbers for the fiscal third quarter, an upward retracement did not occur, likely because so much of the earnings per share increase resulted from a lower tax rate and stock repurchases, not from genuine growth or operations improvements. A breakdown of the company's metrics revealed that operating income fell due to a 1% decline in comparable same-store sales growth in the United States as well as internationally. China, previously a bright spot for growth, saw comparable same-store sales fall 2%. When lowering estimates for the third quarter in June, the company executives pointed to an incident of racial bias that occurred in April at one of its Philadelphia locations. As a result of that episode, Starbucks pushed back some of its planned marketing programs in the United States. At the same time, sales in China suffered from government curbs on third-party delivery services. Despite the Q3 issues, Q4 was stronger. Starbucks was seeing noteworthy results from newly implemented tools that zero in on customers who do not belong to Starbucks Rewards, that's its loyalty program. These new tools allow Starbucks to harvest email addresses as well as create statistics from their occasional customers. The company can then craft customer-specific offers for those individuals. The coffee giant's two biggest markets showed significant fourth quarter increases in comparable same-store sales. According to its earnings report, Starbucks saw fourth quarter comparable sales growth of 4% domestically and 1% in China, overshooting the street's outlook for both numbers. Globally, comparable sales increased by 3%. That's a solid number. The comp sales bounce back pushed revenue up by 11% and fueled a 13% upward movement in adjusted earnings per share, which came in at 62 cents or 2 cents ahead of most analysts' expectations. Adjusted full-year earnings per share of $2.42 was at the upper end of the company's revised projections. Still, keep in mind that comparable same-store sales growth in the United States remains below the numbers Starbucks saw in its recent past. As for China, comparable sales growth is substantially below the high single-digit rates that the norm was only a few quarters back. In both cases, the sluggishness may be due to sales growth strategies which have not fully kicked in yet. Domestically, the company hasn't rolled out their customer-specific offers for folks who are not in their rewards program, but these initiatives are expected to gear up in the near future. In China, Starbucks embarked on its much-vaunted delivery alliance with Alibaba in Beijing and Shanghai in September. In the last weeks of October, the program expanded to an additional 9 cities and will be in 30 cities throughout China by the end of the year. Together, these ramped-up strategies in the United States and China should accelerate growth in comparable sales during the coming quarters. Starbucks anticipates growing by about 7% in fiscal 2019 with a net increase of 2,100 new locations. Management estimates revenue will go up by 5 to 7%. This projection takes into account an expected 2% pushback in regard to licensing and selling certain business elements. The increased revenue will be driven by an uptick in global comparable sales that will fall at the lower end of the company's long-term 3 to 5% projections. Adjusted earnings per share estimates call for an 8% to 10% increase, or $2.61 to $2.66. Given the 3% increase in global comparable sales last quarter, Starbucks' guidance may be on the conservative side. The recently implemented digital tools in the United States, the full realization of the company's program for mobile ordering and delivering in China, and easily met year-to-year comps sets the company up for a full-year comparable sales growth of 4 to 5%. If this should occur, earnings per share would end up above the company's current guidance. The outlook for Starbucks improves even more when looking ahead to fiscal 2020 and the years to follow. The company will begin to see the benefits of its recent coffee partnership with Nestle. In addition, it will reap the rewards that come from implementing its new sales and earnings strategies in the next 12 months. Currently, shares of the company sit near a 52-week high, so they are not cheap. However, should the company's strategies for growth kick in as anticipated, Starbucks appears to be poised to continue its upward movement. I say Starbucks has done enough to put themselves back into the good graces of the investors and back onto a growth trajectory. I say Starbucks is a buy.
That's the bottom line, because Stone Cold said so.